Welcome to The Explainer. Today we're diving into two absolutely massive tectonic shifts that are completely redefining money in 2026. Seriously, if you want to understand exactly how modern wealth is being built, and more importantly, protected right now, you are in exactly the right place.
So think about this for a second. What on earth do a faceless YouTuber in Sao Paulo and a Wall Street billionaire in New York actually have in common? I mean, on the surface, absolutely nothing, right? But in reality, they both rely on incredibly specific, highly optimized engines. One uses an engine to aggressively scale their time, and the other, well, they use an engine to fiercely protect their money.
$37,000. Let that sink in. That's the shocking monthly revenue coming from a single solo creator running a faceless AI content factory right now. No massive team, no expensive studio setup, not even an on-camera host. It's literally just one person, a laptop, and an AI engine quietly building an incredible income stream. Now, let's flip the script and contrast that huge success with a pretty brutal reality check. 79%. That's the percentage of highly paid active Wall Street managers who actually lost to the S&P 500 last year. Just think about that. People pay them massive fees, and nearly 8 out of 10 of these experts still get beaten by a basic automated market index. Wild, right? Section 5, the tale of two engines, time and tax efficiency. We're going to break down the active income engine of AI for generating cash, and the passive wealth engine of ETFs for keeping that cash safely out of the taxman's hands. Section 6, the AI content factory. Let's jump right into our first engine. This is exactly how creators are printing money by scaling their time in 2026. So when you're setting this up, tool selection is absolutely crucial. If you're trying to write a typical 12-minute script, Claude Opus 4.7 is the reigning champion right now. Why? Well, it can actually maintain its tone for over 8,000 words. ChatGPT 5.5 is great, sure, but the data shows it starts to drift and sound, a bit robotic after just 1,500 words. And when you're trying to hold an audience's attention for a full video, that tonal drifts, it's fatal. You need absolute consistency, or picking the wrong AI tool will literally destroy your viewer attention.
Here's how the modern 3-step AI pipeline actually works in practice. Step 1, you have Claude Opus 4.7 write the script. Step 2, you feed that script into 11 Labs version 3 for a human voiceover that is virtually indistinguishable from a real person. Step 3, you drop all of that into a Premiere Pro 2026. With their AI text-based editing, a grueling 5-hour edit gets instantly compressed into just 45 minutes. You're taking days of manual labor and shrinking it down to a lunch break. I mean, that is the ultimate leverage. But here's what most people don't know. And honestly, this is where amateur channels completely collapse. They only rely on AdSense. Taking a look at the breakdown of our $37,000 a month creator, AdSense makes up just 18 grand of that. The rest, it comes from a heavily stacked strategy. 10,000 from affiliates, 6,000 from sponsors, and 3,000 from digital products. You absolutely have to diversify if you want any real stability. Section 10, ETFs explained simply. Okay, so you've built the income engine, right? Now, how do you actually protect that money? Let's switch gears to our second engine. Think of an ETF, or exchange-traded fund, like a variety pack of snacks. Instead of going out and buying just one single bag of chips, which is like betting on one single stock, you buy the whole variety pack. You get a little bit of everything neatly wrapped up in one simple package. Now, when you buy that variety pack, you do pay a small fee called the expense ratio. It's basically the fund's total annual operating expenses, and it gets deducted directly from your returns. Actively managed ETFs average around 0.69%, but passive index ETFs, they sit at a microscopic 0.10%. And trust me, that tiny decimal difference is huge. It keeps hundreds of thousands of dollars compounding in your account over a 30-year period. Keeping your fees low is a massive wealth accelerator. It really helps to visually contrast the old guard with the new here. Mutual funds are only priced at the very end of the day, and if you want to cash out, the manager actually has to sell stocks for cash. ETFs, on the other hand, trade super flexibly throughout the entire day, exactly like a stock. But their real superpower? That comes from a mechanical trick called in-kind redemptions. Section 13, the ETF tax loophole. And guys, here is what most people simply do not know about the tax code that makes ETFs so incredibly powerful for protecting your wealth. Let's break down this whole in-kind redemption process step by step.
Say you own an S&P 500 ETF. Behind the scenes, there's a large institution called an authorized participant, or AP, that handles creating and redeeming the shares. When people want to sell their ETF, the AP doesn't force the fund to sell off its assets for cash. Instead, the AP simply swaps a basket of actual underlying stocks, like shares of American heavyweights, Apple, Amazon, directly for the ETF shares. Because no cash is actually exchanged inside the fund itself, zero capital gains taxes are triggered for all the investors who are still holding on. And because mutual funds don't use that incredibly efficient swapping process, look at this number, 53%. A staggering 53% of active mutual funds were forced to distribute a taxable capital gain to their investors last year. Imagine not selling a single share of your own mutual fund, doing everything right, but still getting slapped with a massive tax bill just because other people panicked and sold theirs. It's incredibly frustrating, and it completely eats away at your compounding growth. But contrast that with active ETFs. Only 9% of them triggered those same taxes. Thanks to that brilliant in-kind redemption process, ETFs act as this massive tax shield. They keep significantly more of your hard-earned money compounding tax-free right where it belongs, in your pocket. You stay entirely in the driver's seat of when you pay the IRS. Section 17. Biggest beginner money mistakes. All right, we've covered both engines. Now let's talk about the frustration of losing your hard-earned money and time by exploring exactly what not to do. Seriously, these beginner mistakes will either get your channel demonetized fast or totally drain your portfolio. First up, relying only on AdSense. We already covered that. You absolutely need multiple income streams. Second, failing to disclose AI usage to YouTube. The platform doesn't ban AI, but it will strictly penalize undisclosed, low-effort content. Third, buying active mutual funds in a taxable brokerage account. You're just asking for unnecessary tax bills with that one. And finally, cloning celebrity voices. Just don't do it. It triggers immediate channel takedowns and opens you up to massive legal exposure. No way is it worth the risk. Section 19, your ultimate takeaway. Let's bring this whole thing together where time optimization beautifully meets tax optimization. Here is the true blueprint for 2026. It all boils down to this one core philosophy. Efficiency is everything. Protect your time with AI and protect your money with ETFs. Really, if you only remember one single thing from this entire explainer, let it be exactly this. Mastering these two specific vehicles is exactly how you secure real financial freedom moving forward. Just think about how these advantages compound over time. If you use AI to get your precious time back, you can build even more income streams. And if you use ETFs to shield that cash, your wealth is going to grow exponentially faster. It's this massive, unstoppable snowball effect. So you have to ask yourself, are you building an engine or are you just running on a hamster wheel? Hey, make sure you subscribe so you don't miss out on more of this, and definitely join us for our next explainer, where we're going to take a deep dive into Tier 1 AdSense CPMs. See you then.